What's up, guys? Welcome back to DCA. Tonight what we're going to do is take a look at a metric which can help you define when long-term holders of Bitcoin are starting to sell into market strength or starting to hold their assets into market weakness. So if you guys like this type of content, hit like and subscribe. You could head over to the Discord channel where you can find the DCA Index Risk Model. This is a machine learning algorithm model that I've created which helps you to identify where market cycle peaks and bottoms may occur. This model is a trading view indicator. It's entirely free. You can sign up for it on the Discord channel. So we're going to be looking at a topic today that was recently covered by Glassnode. However, we're going to take a different approach to this metric. We're going to show you how what we're looking at today can be used to identify when large net worth long-term holders are moving a significant number of coins. The reason we want to know this specifically is the fact that when this is occurring, this is the event that typically begins the early stages of a bull run and sort of creates the end of the bull run as these individuals are selling more and more coins. You can also identify when these investors are beginning to hold the asset and have ceased to liquidate. So what we're talking about today will be the median value of coin days destroyed. I'm going to show you how with this metric in every market cycle and almost every local top, this metric has indicated to you that these holders of the asset are starting to sell coins. So let's just talk about why this is in general terms. As the market cycle is progressing, and we're, let's say, in the beginnings of a bull run, you have large, high net worth investors beginning to sell their asset. You also typically have new entrants into the market. So as these new entrants are coming in, they are buying the asset as the price goes higher and higher. So this is the price of Bitcoin. And as we're entering into the bull market, these individuals are beginning to sell their asset. As this happens, you have new entrants coming in because, people are hearing about it in the media, it's in social media, it's just popular, it's a trending topic. So you have new entrants coming in, trying to buy as much as they can, trying to FOMO into the market as the bull market continues and the price goes higher and higher. Now, as this is happening, the rate at which large net worth investors are selling their asset that they've been holding for prolonged periods of time, that rate increases. At some point, the rate that they are selling overwhelms the rate at which individuals are buying or willing to buy anymore. And that's how you get a market cycle peak, and then we fall into a downturn. So we're going to look at how this rate at which individuals are selling interacts with the actual price and how you can see that in almost every local top or market cycle peak, we see a very consistent trend happening. First of all, we need to talk about what is a coin day destroyed. Well, let's say you put a Bitcoin into a cold storage wallet, just one Bitcoin. If you did that 100 days ago, that coin has accrued 100 coin days. Now, what is a coin day destroyed? Well, let's assume that that Bitcoin that you had sitting in a wallet for 100 days, and then you move it onto an exchange in order to sell it. Well, it loses those 100 coin days that it had previously accrued. So in other words, 100 coin days destroyed. So this is coin days destroyed. All right, so for any given day, it shows you how many coin days were destroyed. In order to get an accurate gauge of this metric, you have to consider the supply, because obviously you can move more coin days when there's more coins. So what we do then is take this coin days destroyed and divide it by the total supply of Bitcoin. All right, and that gives us this, the supply adjusted coin days destroyed. So you get a much more even idea of how many coins are being moved on any given day. Okay, so with this supply adjusted coin days destroyed, what you can do then is multiply it by the price. And this gives you a value of coin days destroyed. It moves very similar to the actual price level. but it's a very noisy graph. So what we can do from there then is take our value of coin days destroyed, and in order to get rid of a lot of the noise from the metric, we can just look at the median value for the last 50 days. Okay, so what we're going to do is take the median value of the coin days destroyed over the prior 50 days, just to sort of clean up the data. And the reasoning behind it also makes sense. When you have sell pressure constantly occurring in the setting of either a bull run or a bear market, it sort of takes time for that pressure, that constant pressure, to reflect in the actual price. So, when someone moves coins onto an exchange, let's say, the price won't necessarily, unless it's just a massive quantity of coins, the price won't be reflected necessarily immediately. And that pressure builds up and builds up over time, both in the bullish and in the bearish direction. Okay, so what we'll be looking at is this here, this red line. This shows you the median value 50 of coin days destroyed. So with this metric, we can see that in more bearish times, the metric is spaced from the actual price. Okay, and these are on the same scale because remember, we're looking at the number of coin days destroyed divided by the supply multiplied by the price. So when we come into more bearish times, you see that there's a large gap between the actual price, which is on the color-coded dimension, and the MV50 coin days destroyed, which is in red, right? I should also mention that the color-coded dimension is simply the DCA index risk model. And when it is in red, this is telling you that you're nearing a market cycle peak. And when it's in blue, it's telling you that the risk of buying the asset is very low in the long term. Okay, so this is a long-term price metric which is attempting to identify market cycle peaks and bottoms. Down here, what we have is the price divided by the mean value of coin days destroyed. So, it sounds like there's a lot going on here, but there really isn't. All we're doing essentially is looking at how many coins are being moved. When there are a ton of coins being moved, this value in red is going to be much higher. And then we multiply it by the price and divide it by the supply. So it just gives us a sense of how many total coins are being moved on the network every day. Now, as we approach these lower prices, what you see is this value start to fall. And what that indicates is long-term holders are no longer incentivized to start selling their asset because they believe that the future price will be higher. So when they believe the future price is higher, you see this value fall. Okay, so if we just take a look here, for instance, back in the bear market of 2015, the median value of coin days destroyed was around $36, whereas the actual price was sitting up here at around $236. Okay, we could then take a look at back in 2017. So at this time on June 2nd, the median value of coin days destroyed was around $1,400, whereas the actual price was up at around $7,600. So that means that long-term holders believed that it was more advantageous to them at that time to hold the asset waiting for better prices. Okay, so, long-term holders are holding, waiting for better prices when the price tends to be lower, and they start to sell the asset at increased rates when the price tends to be higher. That's well known. There's nothing groundbreaking about that. So what we're going to do is, and I think this is the thing that you can use that is actionable in terms of understanding how the market is operating, is by looking at this ratio. So we're looking at the price divided by the median value 50 of coin days destroyed. This gap increases in size in the setting of bear markets. And that just indicates long-term holders are holding the asset. But what we want to do is understand what this can actually tell us. All right. And if it can identify for us in any way when the market is nearly reaching a top or even when the market may be nearing a bottom. So let's take the instance of, can it identify where market cycle tops occur? And we don't want to just know the day of the top. We want to know, can it identify well in advance that the top may be coming? And in my opinion, this metric is actually very accurate in this regard. Let's take a look back to each market cycle. So we'll start over here in 2013. So notice that we have our double top cycle in 2013. So the middle of 2013 and the end of 2013. So down here, the median value of coin days destroyed is with respect to the actual price. So when this value, the MVOCDD, is much lower than price, this value is higher. So it's just price over the median value. So when you're at these very high levels, these are bearish times. And again, it's color coded with the DCA index risk model. You see that each time it approaches 1, when the median value of coin days destroyed is actually at least equal to the price. So in other words, the median value of the number of coin days destroyed, whatever that value is, it's actually equal to or higher than whatever the price is. And where does that occur? So let's just take a look here. Well, notice that this actually occurs before the actual market cycle peak. So this gives us a few weeks ahead of time. All right. Then if we just bring this over and then look at the end of the market cycle in 2014, again, it tells us before the market cycle is over. So in other words, the number of coin days destroyed, the rate at which long-term holders are destroying coins, is very high just before market cycle peaks occur. So we see this again in then mid 2017. We get this place where the median value of coin days destroyed goes over the actual price. At that time, we're right near the end of our market cycle. In this case, it's a few months ahead, but nonetheless, we're approaching the end of our market cycle. Okay, and you see that we then again go over this value right here in December, right actually at the end of the market cycle for Bitcoin itself. So just a few days before the end of the market cycle, you see that this line crosses over this red line here and indicates that we're very close to the end of the cycle. And then again, in this market cycle, you get down to this level right around December as the price is going into the $20,000, $30,000 level. And we all know that's just a short amount of time before we actually sort of run out of steam. As we're getting into the $40,000, $50,000 level, the market is running out of steam. And that's because the long-term holders are exhausting the total number of buyers because they're selling into the retail market who's buying the asset. And again, it's giving you about 4 months of warning prior to this market cycle top that we saw at 64K in April. So back in 2018, and if you go all the way back to 2013, it's giving you weeks to months advance notice that long-term holders are selling enough coins such that the value that they are selling is matching or at least equal to the price. And when we see that happen, when we see this value drop below 1, that typically indicates that we are very near, at least on the long-term holder scale, we're nearing a market cycle top. So what you had in late 2021 in November was a situation where the long-term holders began to sell, okay? But, they sort of weren't moving a large number of coins. If you notice, the median value of coin days destroyed never actually got to the actual price level. And you've actually seen this before. We saw this occur back in 2019. Okay, so see here in 2019, there was a small rally. This value started to approach 1, but did not actually get to 1. It only got to about 1.5. All right, same thing here. We got to almost this identical level. So this was sort of a mini bull market where, there's not a large amount of retail interest. There wasn't a, strictly speaking, a euphoric phase where new entrants into the market are coming in, FOMOing in like crazy. It was simply a lot of people that were already around from this prior cycle back in December. Okay. So there simply weren't enough new entrants into the market to sort of fuel a sustained rally that we would typically need to see to take prices much higher. And that's why, a lot of the long-term holders just held on to the coins that they had already accrued. And remember, many of them sold a lot of these coins already back here in early 2021. So the end of 2020 all the way into early 2021. So you see that reflected down here on the graph. Remember, as we're approaching this red line down here, that's indicating to you that you have a large number of coin days being destroyed. And notice when this is down here for prolonged periods of time, down below this 2 into the 1 level, that indicates long-term holders selling and selling and selling. And that's what we saw all through the beginning of 2021. And then you see them starting to hold again right here in May all the way through July. Now notice where we're at right now. We're actually at a very high level. In fact, we haven't been at this level where we're at since basically the depths of the bear market back in 2018. So you saw the level of coin days destroyed get to kind of where we're at right now back in 2018. So this doesn't indicate that the downward trend in the market is necessarily over, but it does tell you that, at least historically speaking, if you look back to the 2014 and 2015 levels, when you're at these very low levels like we're at right now, while they may not be great short-term times to buy into the market, these tend to be extremely good long-term buying opportunities. Okay, so just looking at the numbers, strictly speaking, we are right in this right around this 5 to 6 level. Okay, so if we just go back and historically look when we've been here, we were essentially here for a short amount of time in 2018, and this just indicates that long-term holders are holding. They're just not willing to sell much of the asset right now because this level is very far removed from the actual price, this median value of coin days destroyed. So you're seeing a place right now where long-term holders are just sitting on the asset. Even if the price continues to fall, that's typically just indicating that short-term holders are capitulating, which is fine. That's fine if they're capitulating, because that's sort of the event that you need to occur to get market resets and eventually go on a large bull run into much higher prices, because we don't care about a $69,000 Bitcoin. We're interested in the $100,000 Bitcoin plus. Now, that's not to say we can't go higher from here, because if you notice, we have had a sharp and steep sort of move to the upside here. And remember, the upside meaning that long-term holders are no longer ready to sell. So typically when you see these large, rapid moves to the upside, they're typically followed by at least a short-term large rally. When we had this move to the upside right here, well, when was this? When we got into this range right here, well, this was right before our rally that we had at the end of July into August. So typically speaking, it doesn't mean this is the end of the downtrend that we're in, but it is at least a good shorter term indication that we may get a large price increase from here. And in fact, we've gone from 32K up to where we're sitting at now at around 44, 45K. Strictly speaking, we have seen a decent rally. So that's basically what we wanted to talk about on this one, guys. I just wanted to show you how this metric is just another tool that you can add. So you can use this to very well identify where the market is becoming overheated. The long-term holders are selling numerous coins into the retail market who are buying the coins in the short term, and you may not necessarily be right at a market cycle top, but you're likely to reach one in short order because, quite frankly, the market can only sustain that type of sell pressure for so long before it needs to turn around. And you've seen it in every market cycle. And I think you will continue to see this occur in every future market cycle as well. As the sell pressure and the number of coin days destroyed begins to meet the actual price level, you'll likely then see within a few weeks or a few months a market cycle peak. So you can begin, you can use that to begin dollar cost averaging out of the market during these times. So that's going to be it for this one, guys. If you guys like this type of content, hit like and subscribe. You could head over to the Discord channel to sign up for the DCA Index Risk Model. I also have a lot of TradingView indicators in addition to that I put on there, and you can sign up for all of these for free on the channel. So that's it for this one, guys. Until next time, as usual, see you.